So what if the one thing that you thought was protecting your retirement is actually setting you up for a massive tax bill? We've all been taught to use low conservative return assumptions to play it safe, and for good reason too. Traditional retirement planning usually starts with one big question: will I run out of money? And then if there's time or space, it backfills in a little tax efficiency. But here's the thing. The IRS doesn't care how conservative your plan is, and it doesn't care how much income you actually need in retirement. Once you hit the required minimum distribution age, they start forcing you to pull money out of your pre-tax accounts. And for most retirees, these pre-tax accounts make up 70% or more of their portfolio. So even if your portfolio has just moderate growth, let's say 6% or maybe even 8%, you could end up with far more taxable income than you ever expected. So in other words, the problem that you spent your whole financial life trying to avoid, running out of money, might never happen. But instead, you might be facing a very different threat: being taxed on a whole lot of income you didn't even need. And here's the kicker to all this. If you had tested your plan using a few different rates of return early on, instead of just testing for disaster, I can almost guarantee that the future you would have said, yep, let's do something now to keep that tax bill lower down the road. But most plans don't model for that. They just stop at, you won't run out of money. They give you a high probability of success and call it a day. But that's not enough, because if your plan doesn't prepare for success, if it doesn't ask, what happens if things go better than expected, you might be walking straight into a massive, but very avoidable, tax burden. Let me show you what I mean. And I'm going to use the sample couple that I use in a lot of my planning cases. They're both 63 and they just retired. They have a joint account with $400,000 and pre-tax IRAs with $2.1 million. At full retirement age, one has a Social Security benefit of $3,300 and the other will get $1,850 per month. Now they want $9,000 per month to spend after taxes have been paid, and they plan to increase that every year for inflation. Now, they planned out their retirement income to follow the data that they had read on retirement spending, where income takes a small cut at 80 and another small cut at 90. And to keep this clean, I did not include the cost of long-term care, since that would just muddy the waters up. So this is what the income would look like over the course of their retirement: a nice steady line with two small decreases. Now let's overlay their taxable income. And in this first example, I want to show you what their taxable income would be if their average return throughout retirement was 4%, because that's a number that I find is very commonly used in retirement projections. Well, you can see that taxable income as compared to their income need, it doesn't give a real big difference in there. Now, it doesn't look like a difference, but if you dive in, there really is a sizable difference, because by age 80, their taxable income is $62,000 higher than their income need. But it does stay fairly tame throughout the course of their retirement. And yeah, it stays higher than the income need, but not so much that we could construe this as a tax avalanche. But remember, this is at an extremely conservative 4%. Now, let's look at 6%. Now, at this point, we can see that there's a lot more taxable income coming in than they need. And now this is starting to look very inefficient. By age 80, that's $115,000 higher in taxable income than what their income need is. So now this is starting to look like a big tax problem. So now let's take it one step further. Let's look at an 8% return. Now that's a long-term return that, based on history, is very realistic for people. But, most people would think that it's almost malpractice to use a return like this in planning. And I certainly think that's the case if you're trying to test for, will I run out of money? But when you're looking at the future taxes, I think it's something you need to test. Because at 8%, things really go off the rails. By age 80, their taxable income is more than $230,000 higher than what they actually need to live on. And this is what a tax avalanche looks like. A plan that was designed to be safe has now become wildly inefficient because it only tested for failure. It asked, what if things go bad? But it never asked, What if things go better than expected? And I'd be willing to bet that if this couple could go back in time, they would jump at the chance to take advantage of those early years when their taxable income was still low to start reducing the size of their IRA, whether that's through Roth conversions or just changing up their withdrawal strategy. Either way, there were some opportunities to lower their future tax bill, but they just didn't see them at the time because they only tested for failure. And unfortunately, by the time those RMDs hit, it was too late to fix it without them having to write some very big checks to the IRS. So how do you avoid walking into this trap? Well, the good news is you don't need a crystal ball. You just need to recognize that the early years of retirement are your window. This is your opportunity before required minimum distributions kick in to take control of your tax future based on what we know now. You worked too hard to save this money just to watch it get taxed away in your 70s and 80s. And so if you're still in that pre-RMD window or even approaching it, now is the time to get ahead of this. A little planning now can save you a lot in taxes later. You know, the bottom line of all of this is that retirement success isn't just about not running out of money. It's about making sure that your plan works in real life across all scenarios, including the good ones. Because if you're not planning for success, you could be setting yourself up for a massive and totally avoidable tax problem down the road. So if you're within a few years of retirement, or even if you're already there, this is the time to take a second look. Are you missing a chance to reduce taxes now while your rates are still low? And are you preparing for the day that RMDs will force your income up, and income that you don't actually need? And if you're not sure, we can help you with that. We help retirees build clear retirement income plans that work in both good times and bad, so you can have confidence that the IRS won't take more than you've planned for them to take. And if you want to help make sure that your plan is not prepared for risk, the failure, but also for success, I'd be happy to talk. There's a link down below where you can get in touch. Thanks for watching.